My pleasure to introduce you, Ian Williams from Charteris Portfolio Managers. Good to have you on the show, Ian. I have an interesting quote from you from a few weeks ago. You're saying investors are getting carried away with the euphoria surrounding quantitative easing. Do you stick to that quote? Today, obviously, we want to know from the FOMC if they follow the cue given by Mervyn King.
Yes, I think they possibly will. What I meant by the quote was that investors seem to be focusing too much on the minutiae and one particular part of quantitative easing, which is the Bank of England buying back gilts. If you look at the complete package, the government as a whole is still a net seller of gilts. I mean, if there's a £125 billion budget deficit and the Bank of England buys 75 billion, the government is still a net seller of 50 billion. And what I also said was that the way that the quantitative easing is being done in the UK is probably a wheeze to get round the Maastricht Treaty, which prevents, as the UK is a signatory to the Maastricht Treaty, prevents the Treasury selling gilts directly to the Bank of England.
Now, they have been successful, it is said, to, at least in the short term, bringing down long-term yields. They drop below the 3% level. Now, going forward, how is this going to play out? Will they keep rising or will they keep falling?
Well, we think the long-term implications of this are quite inflationary, because what effectively is happening is the government is monetising its budget deficit, and as a result we think the long-term implications will be that index-linked gilts will be a preferable investment to conventional gilts, and we think at the very long end of the gilt market, the conventional market, that the yield curve will potentially steepen quite sharply.
Looking at now the 10-year gilt trading closed last night at 3.07%. Where will it go now?
Well, we don't think the 10-year gilt will come to too much harm. We think the danger area in the gilt market is the 40 to 50-year gilts.
All right.
And we think that's where the danger lies. But equally, we think where the reward lies for any investors looking is potentially in the index-linked sector.
All right. Now, tying this in with the broader economy today, we're looking for unemployment data. How far or how high could jobless numbers rise?
Well, I think over, again, the medium term, you could easily see another 1 million people added to the unemployment register. Unemployment is a lagging indicator, so it's going to carry on rising well after the economy turns.
Another 1 million this year? What kind of time horizon are you looking at there?
Over the next 12 months or so.
And what do you expect the government to do? I mean, they've come up with various ideas.
Well, I mean, they've gone down this path of quantitative easing. We think, our view is that quantitative easing will eventually work and it will eventually turn the economy around, but it will turn it around at a cost, and the cost is that further down the road you will get higher inflation.
Thank you so much, Ian Williams there from Charteris Portfolio Managers.